This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 6 videos on trading ranges. I'm going to begin by talking about trading ranges that are very tight. The height from the bottom to the low is small compared to a minimum scalp size. Next, I'm going to be talking about ledges. A ledge is a tight trading range where at the top of the ledge or the bottom of the ledge, there are 3 or 4 bars or 5 or 10 bars with exactly the same price. And that can set up trades. And then finally, I'm going to be talking about a limit order market. Sometimes a tight trading range is tall enough for traders to scalp. But if you're going to scalp in a very tight range like that, it's usually better to be entering only with limit orders instead of with stop orders. Sometimes on television you'll hear traders talk about dead money, and they're usually talking about the daily chart, and usually after a big move down, like this, a very big bear trend, and then you start to get small sideways bars. The idea is if this is a daily chart, this is several months of trading, you're not going to make money trading here, buying or selling. It's better off looking elsewhere to trade. Whenever the market goes sideways for even 2 or 3 bars, usually 10, 20, or 30 bars in a very narrow range from top to bottom, I call it a tight trading range. Most traders should not trade when the market looks like that on any time frame. Let's say this is a daily or weekly or monthly chart of a stock. It has a big bear trend, and then it starts to get a lot of overlapping bars, very prominent tails, small bodies, lots of dojis. That is a dead money type of chart. I use the term tight trading range. If it goes sideways for 20 or more bars, you should look elsewhere to trade because it's very difficult to make money in this kind of environment. Tight trading ranges are common and they occur on all time frames and in all markets. When you see them, most traders should look elsewhere to trade. The concept behind dead money, in a stock, for example, it sells off and then it goes sideways. The idea is that it has to go a long time before bulls believe the bear trend has stopped. And after about 20 or 30 bars, the probability of a trend reversal up becomes as high as the probability for trend reversal down. During this process, 20, 30, 40, 50 bars, 100 bars, very little profit potential. No return on investment, so it's dead money, and you should trade elsewhere. In general, whenever you see a trading range, you should look to buy low, sell high, and scalp. If a scalper cannot make money buying low or selling high, using stop orders to enter, then the trading range is tight. If you sell here, you don't make money. You buy here, not enough room to make money. That is one way to determine if a trading range is tight. If you look at the chart and stop order, traders are not making money, then the range is tight and it's better not to trade the market. Selling here, selling here, selling here, you're not making money. Selling here, not making money. Buying here, buying here, buying here, buying here, not making money. Buying here. Whenever it's difficult to make money, even buying low and selling high, if you're using stop orders, the trading range is tight and therefore you should not trade. Here are examples. Lots of entry setups, but very few profitable trades. A limit order market, not good for stops, therefore a tight trading range. Same thing here. Rather than trading this and not making any money and taking a lot of trades every little reversal, it's better to wait for a breakout up or down before trading again. Here we got a little breakout and some follow through. This looks like it could be the start of a trend. Traders might start to buy closes here, or they might buy this high 2 buy, 2 legs down, 1 and then a bull bar, and then 2 and then another bull bar, or a pullback from this breakout. Some traders will buy the breakout, consecutive bull bars, close above the high of the past 60, 70, 80 bars. It's not yet a big bar closing on its high, but it is an early breakout. If you do take that buy, and you are correct that this is the start of a bull trend, it should not come back below the bottom of this breakout. We have a small triangle here, 3 pushes down, bear, bear, bear bars. Then we have a small bull bar closing on its high. Traders can buy the pullback. It's a bull flag, a breakout here, and a pullback from that breakout, another bull bar, buy above the high of that bar. And this was what ultimately followed. You obviously could buy closes on the way up here. Strong breakout, good follow through, high probability that we'll get some kind of measured move up. The trading range has the word range in it, and that implies that there's a top and a bottom, and therefore there's a channel, but it's horizontal. Like all channels, they can be very broad or they can be very tight. By broad, I mean a lot of room from top to bottom. Stop entry traders usually can make money buying at the bottom and then selling below bars at the top. When they're tight, very difficult to make money buying above bull bars, even very good-looking bull bars like this. Usually better not to trade when they're tight. Very broad range. Traders can buy above bull bars at the bottom, sell below bear bars at the top, and plenty of room for a scalp or a swing trade. Also, when it's broad, traders can enter with limit orders, betting that breakouts will fail. They'll buy below bad-looking sell signals at the bottom of the range. They'll buy below prior lows, so they'll buy at that low. Not a good-looking bear flag, a bull body. They'll buy at the low of that bull bar, get filled here, and they'll also buy at this low, betting the breakout will fail. The opposite is true at the top. They expect a top of the range, and they'll start selling above bars. They'll sell with the limit order at the high of this bar, get filled here. They'll look at this and say, well, that's a pretty bad-looking bull flag, a doji after a big bear reversal bar. They'll sell with the limit order at the high of this bar and get filled here. If it's a broad channel, you can also enter with market orders when there are strong reversals. For example, we have a good bull bar here, maybe a wedge, 1, 2, 3, maybe a wedge, 1, 2, 3. And we have a good entry bar. Some traders will buy that close or buy this close. Same thing here. Spike, pullback channel, 1, 2, 3. Not a good looking buy signal bar, but a pretty good reversal up, probably at least a couple legs up, 1 pullback 2. So traders will buy that close. Opposite is true on the way down. When you see a pretty strong reversal down, and then you see a weak attempt to reverse back up, a lot of traders will sell at the market as this bar is starting to turn down. They might get filled here, they might get filled here. And the same is true here. They see a weak buy signal bar after 2 legs up, 1 pullback 2, and as it's starting to reverse down, traders will sell at the market. And if it's a strong leg down, here we have 3 consecutive bear bars closing below their midpoints. They'll sell the close of the bar, betting that will get down near the bottom of the range. On the other hand, if the range is very tight like this, it's better to not trade and wait for a breakout. There's always a breakout, but you might have to wait a long time. A ledge is a tight trading range where either all the highs are at the same price or all the lows are at the same price. Here we have 3 bars with exactly the same high. That's a small ledge top. The same with here, small ledge top. This is 2 bars at the same price. And the same with this. I usually don't call that a ledge. Here we have 4 bars. This is a ledge, and you can see the market eventually broke above it. And here is a ledge. For a ledge, I refer to 3 or more bars with an identical high. If it has 4 or 5 or more bars at the same high, it's an even more important ledge, a more important magnet. A ledge is a magnet. If the market breaks above it, it usually pulls back at least a little bit below it. If instead it tries to break below it, it usually will eventually break above it. When you have a ledge, 3, 4, 5 bars here, this looks like about 8 bars all at the same price, and the market tries to reverse down, there's an 80% chance it's going to get above the top of that ledge. Sometimes it'll take a few days, sometimes it might take a week, but usually in a small ledge like that, it'll get above it today. If not today, then tomorrow. We have a ledge bottom here as well. We have 4 bars with exactly the same low. Therefore, it's a magnet, and if the market goes up, 80% chance it's going to get below this ledge at some point, either today, probably tomorrow. Perfect ledges, you don't see them much in Forex markets because micropips create too many price levels, and also the prices are not perfect. If you think about it, if an average Forex chart has about 50 pips range, traders now are using micropips. That means that there are 500 different prices from the low to the high in that day. If the E-mini has a 10-point range, there are only 40 prices that day. And it's easier to get identical prices if you only have 40 possible prices than it is in a Forex chart where you have 500 possible prices. And every broker has its own price charts. Therefore, the odds of getting ledges in Forex markets are much less. So these ledge setups are much better for E-minis and also stocks. The market tried to get above this price level 8 different times. We have 8 bars with exactly the same high. And every time it comes up here, it sells off. There's an 80% chance we're going above this ledge, usually either this day or the next day. And once you get above the top of the ledge, there's an 80% chance you're going to get a test back below the top of the ledge. Here we got a reversal. We have a ledge bottom with 4 bars, 80% chance we're going to get a break below the ledge, and 80% chance after we get a break below the ledge, we'll get a pullback back above the bottom of the ledge. It might come today, it might come tomorrow, sometimes it'll come even a week later. Can you see a ledge here? Well, we have 4 bars with exactly the same low, and therefore 80% chance we're going below this low at some point, usually within a day or two, and 80% chance after we get below it, we'll test at least a little bit back above the bottom of the ledge. It's a tight trading range, and therefore a magnet, and that means that the market gets drawn to it. It usually has to poke below it, and once below it, it's still a magnet. The market usually has to poke at least back above the bottom of the ledge. %80 chance, even with this strong rally, we're going to get below the bottom of the ledge. And once we do, 80% chance we're going to test at least back above the bottom of the ledge. That's important because when you see the ledge and you get a rally, traders will look to sell that rally. And then once they get a reversal down, they'll look to sell as well because they know the odds are we're going below that low. This is a close-up of this. And what do you see? You see a lot of bars at the same price. 9 bars all at the same price. The market could not get above it and started to sell off. But it's a very important price. The market tested it 9 times exactly to the tick. the odds are the market has to get back above that ledge. Usually it gets there either today or tomorrow. Here we sold off strongly, and then it took 9 days in a broad channel to get back above the top of the ledge. And it broke strongly above. However, 80% chance that if you break above the ledge, the market will test back below the ledge, which it did on this day. The breakout above and the pullback below. Sometimes you can have a tight trading range, but the range is broad enough for limit order traders to make money. That is what I mean when I say that the market is a limit order market. Don't trade with stops. Only experienced traders should take the trades. I don't have a price scale on the side of this, but the market's reversing every 2 to 3 bars. Very difficult to make money. Entering with stops, selling below bars at the top, buying above bars at the bottom, taking any trade in the middle third of the range. That is not a good stop order market, and therefore if you're going to trade, the only way you can make money is entering with limit orders, which basically is the opposite of a stop order. A limit order, for example, you're looking to buy below bars in the lower half. You buy a breakout, betting the breakout will fail. A stop order trader would sell below this bar and get filled here. A limit order trader does the opposite. He places a limit order to buy at that low. Up here, a stop order trader would buy above that high and lose money. A limit order trader would have an order to go short at that high, and as soon as the market went above that high, he would get short and he would make money. Buy zone, the bottom half or the bottom third. Sell zone, the top half or the top third. Bulls and bears both are scalping. They're expecting the range to continue and not become a trend. They know eventually it will become a trend, but as long as it's sideways, they assume it'll continue sideways. They tend to use wide stops. Many of the experienced traders will do that, and they're willing to scale in. For example, place a limit order to buy at the prior low, you get filled here. Place a limit order to buy at that low, and you get filled here. Place a limit order to sell at this high, filled here. Sell this high, get filled there. Can you simply trade all tight trading ranges with limit orders? No, it's better to have certain minimum requirements. Sometimes the tight trading range is too tight to make money. Most of the time, traders will only trade if most of the bars are at least the size of a scalp. This is the E-mini chart, a 5-minute bar chart. In general, a lot of traders will not trade unless most of the bars are at least 4 ticks tall, which is the size of a minimum scalp. They also want the height of the entire range, from top to bottom, to be at least 3 times bigger than the smallest scalp. So the smallest scalp, 1 point, so they want the height of the range to be at least 3 points tall. And they also want the height of the range to be about 3 times the size of an average bar. Here, an average bar is 4 or 5 ticks tall. So before they trade, they want the height of the range to be 3 times that. The range here is 27 ticks. This is a tight range. You can see we have 6 sideways bars, 3 here, 3 or 4 here, 3 here. The market is reversing every 2 to 3 bars. However, the height of the range is 7 points tall, 28 ticks. So that's 3 times bigger than the minimum scalp, 4 ticks. And the average bar here is 8 ticks. 28 ticks is more than 3 times that as well. Therefore, even though it's a tight trading range, many experienced traders are willing to trade with scalps using limit orders. Most traders, they should not trade whenever the range is tight. The profit potential is small. It's a lot of work, and it's easy to lose money with just a couple mistakes. If it's tight, but big enough for scalps, some traders will trade with limit orders. Again, if it's tight, you should not be entering with stop orders. because most of the breakouts will not go far enough for a swing trade. Most of the breakouts won't go far enough for a scalp, and you don't want to be buying too high or selling too low when the range is tight, because you have to bet that each leg up or down is going to reverse within a few bars. Another tight trading range, lots of reversals. The legs up and down only go a few bars before you get a reversal. Every bear bar followed by a bull bar, every couple bear bars followed by a bull bar. Bulls and bears both believe that a big move up or down is unlikely. The market is going sideways, lots of overlapping bars, prominent tails, bull bars followed by bear bars followed by bull bars, here and here, here and here. A big move up or down is not likely. Bulls will buy below bars in the lower half, betting that bear breakouts will fail. However, because they believe the move won't go up too high, they take quick profits. They scalp. They buy at prior lows. The market's going down. They place a limit order to buy at that low. They get filled here. Market's working lower. They place a buy order to buy at that low, filled here. And the opposite for the bears. The market's trying to go up. Bears will look to sell above prior highs. Here, they get filled. They might have a limit order to sell here as well. A prior high here, they get filled. They might have a limit order to sell here as well. Did not get there. Both will scalp because they do not believe the market will go far enough for a swing trade, and many will scale in and use wide stops. A lot of times they'll enter, not certain if the market is about to reverse, but they are certain it will not go much lower. So for example, a bull who bought here, if he did not take profits up here, he may buy more here, betting that the market's not going to fall too far and it will reverse soon and he'll be able to make a profit. This is the euro versus the dollar, a 5-minute chart. How far should your stops be if you're looking for a minimum scalp? When you're trading forex markets in general, you should always trade for at least a 10-pip profit. If you're trading with limit orders in a limit order market like this, a tight trading range, usually you have to risk 30 pips, sometimes as much as 50 pips, and you usually have to be willing to scale in. Most traders cannot do that, and they're better off not trading when the market looks like this. For example, a bear might sell at this high, get filled here, place a limit order to sell more 10 pips higher, and maybe a stop 30 pips above his first entry. And then when it comes back down to his first entry, he gets out break even on this entry over here, and he gets out with a profit on this entry. He might buy here, and he might be willing to buy more 10 pips lower. It did not fall 10 pips lower, so he did not have an opportunity to add to his position, scale in. And scalpers are going to be taking minimum scalps. The range is tight. It's a 40-pip tall range. Most scalpers will be trading for 10-pip scalps. Lots of opportunities, and it looks easy, but in fact it's very difficult to do. Most traders should not be doing this. Whenever you see a tight trading range, you should conclude that neither the bulls nor the bears have a big advantage. The market would not be in a tight trading range if one side or the other had an advantage. It would be trending up or down. When it's in a tight trading range, 50% chance you'll get a bull breakout, 50% chance you'll get a bear breakout. Tight trading range, the bulls see some kind of a bottom, a double bottom, lower low double bottom. The bears see a double top bear flag. Not quite 20 bars, so not quite equal probability for bulls and bears. The bears still have a slight probability advantage, but not much. If they had a big probability advantage, the market would not be doing this for 10 bars. It would be doing that. Opposite is true here. We have a reversal. Most of the bars are above the moving average. It's a tight trading range, so the probability of a bear breakout is almost as high as for a bull breakout. but because most of the bars are above the moving average and we've had a reversal up, the bulls have a slightly higher probability, but not a big advantage. If they had a big advantage, the market would not be going sideways. It would be going up and up strongly. This is an important thing to notice. Very strong bull trend, a pullback, and then a resumption of the bull trend. Here we have, 8 or 9 consecutive bull bars? And then we formed a tight trading range. However, in the tight trading range, there's a small double top, and it's slightly lower high than this. This, in fact, is a double top, lower high, major trend reversal. And like all major trend reversals, there's a 40% chance that the market will have a swing down. Some bears will take that chance and they'll sell below the low of the double top, so they'll sell with a stop below that bar and get filled over here. Some bears prefer to sell below a bear bar, so they might sell with a stop at the low of this bar, one tick below that bar, and then get filled over here. It never looks like it could possibly work, but whenever you see a tight trading range and a strong trend, you have to be thinking about the possibility of a double top major trend reversal. If it's a bear trend, you got to be thinking about a double bottom, higher low major trend reversal. Even though the trading range is tight, you can get a huge move. Usually you get 2 legs down if it is going to go down, and the second is usually bigger than the first. Leg 1, pullback, leg 2. Higher probability, instead of selling up there, you wait for a strong breakout and good follow-through, and then you sell the close of that bear bar. Higher probability usually means higher risk. If you take that sell, your stop is either here or above the top of this sell climax. Here, you're risking very little. If you sell here, you're risking at least to here, maybe to there. Whenever you have a high probability trade, you have to assume that risk-reward is worse, and that usually means the risk is greater, the stop is further away. A double top, a little bit above a double top, but bull trend, tight trading range, and whenever you see a double top in a tight trading range, you have to be thinking about the possibility of a double top, lower high major trend reversal. Risk is small, and that means probability is small as well. You look at this and you say, I'm going to sell below that bear bar. I'll get filled here. I'm only risking to right here. I'm not risking much, and I have huge profit potential. That is true. Whenever you have a great risk-reward setup like this, the probability of making money is small. You're probably going to lose. But mathematically, it's okay. The trader's equation is positive. In general, if it does work, you get 2 legs down, 1 pullback 2, and the second leg is often bigger than the first. Higher probability, you wait for the bear breakout and you sell either this close or you sell above the high of this bar, betting that the reversal up will fail. Here we have a low 2 short, low 1, low 2, so you can sell below the low of that bar and get filled here, or if you want, you can sell below a bear bar closing on its low and get filled here. These are higher probability shorts than that original short, but the stop is still up here, stop is further away. Whenever you have higher probability, you have to assume that risk is greater, your stop is further away. Usually your reward is less because you're entering after the trend has already gone your way and there's less profit potential left in the trade. When a trading range is very tight from top to bottom compared to the average size of a minimum scalp, I call it a tight trading range. If you have a tight trading range and you have 3 or more bars, usually 4 or 5 or more bars with exactly the same high, that is a ledge. And if they have exactly the same low, that is a ledge as well. If you have a ledge, there's an 80% chance that you'll get a breakout through the ledge, either a top or a bottom ledge, and an 80% chance you'll get a pullback back into the ledge. Sometimes you'll have a tight trading range that is tall enough from top to bottom for traders to make money with limit orders. Usually very difficult to make money with stop orders. I call that a limit order market. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 6 videos on trading ranges.